Welcome back to Talk Tickers. This is the place where we ignore the breathless headlines and all the shouting to actually look at the numbers that move markets.
And today we are tackling a big one, McKesson Corporation, ticker MCK.
That's right. And before you roll your eyes and say, oh, great, the company that drives the vans full of aspirin, just stick with me here.
Yeah, if you think this is just a low-margin delivery service, you are about 5 years behind the curve. It's definitely not just a logistics company anymore.
Not at all.
If you look at this Q3 fiscal 2026 earnings print, you aren't seeing a distributor. You are seeing a technology and services platform that just happens to move physical goods.
A pivotal quarter, really.
Yeah.
But before we get into the strategy, we have to talk about the drama. Because if you were watching the tape right when this report dropped, it was confusing.
Very confusing. The stock actually dipped.
It did. It was down about, what, 0.75%? It felt like the market just shrugged and said, okay, whatever.
That was a classic algorithmic head fake.
Mm-hmm.
You know, the machines probably saw a mixed signal or just didn't parse the guidance correctly right away.
But then the humans woke up.
The minute an actual analyst opened the PDF and saw the composition of that growth, the narrative flipped completely.
It wasn't just a flip, it was a rocket ship. Thursday morning, February 5th, the stock just rips higher, closes up roughly 16.5%.
On massive volume, too, over 2 million shares. For a company this size, that is a huge, huge move. The market basically admitted it got it wrong the night before.
So what did they see? What was the big realization?
They saw the boring distributor discount just evaporating.
Yeah.
For years, investors have valued McKesson like this slow growth, low margin utility.
Right.
But this report, especially the guidance, it forces you to see it as a growth stock. They're capturing value in the high margin world of cancer care and specialty drugs. That 16% jump was the market re-rating the entire business model in real time.
Okay, so let's get into the numbers that triggered it. Top line revenue came in at $106.2 billion.
Which is just, pause on that number. $106 billion in one quarter.
It's wild. That was up 11% year over year, a solid beat against what the street was looking for.
A solid beat, yeah. But revenue can be a vanity metric at this scale. Yeah. The real story was the bottom line.
Adjusted earnings per share hit $9.34. Consensus was around $9.20, so a nice beat there too, up 16%.
But again, a quarterly beat is nice, but it doesn't usually cause a 16% rally. The fuel for the fire was the guidance.
Right. This is where they really surprised people. They didn't just beat, they raised. They raised and narrowed the guidance for the full fiscal year.
They raised the floor and the ceiling. They're now projecting full-year EPS of $38.80 to $39.20.
And what does that imply for growth?
When you crunch those numbers, it implies an earnings growth rate of 17 to 19%. That's the aha moment right there. Yeah. You have this massive industrial-scale company that is accelerating its earnings growth into the high teens. That is so rare. It tells you their margin expansion strategy is working.
And listening to the call, the tone was just confident, borderline swagger. They used the buzzwords, discipline, execution, momentum, but they backed it up with cash.
$1.2 billion in operating cash flow in 3 months. But let's peel back the onion because the where is way more interesting than the how much.
Let's do it. The star of the string was not pill distribution. It was the oncology segment.
This is the crown jewel right now. This is the growth engine.
The numbers are just staggering. Revenue in this segment was up 37% to $13 billion. But operating profit.
Oh, the operating profit.
Up 57%? 57. That is incredible leverage. But I have to ask, isn't a lot of this just them buying other companies?
It's a mix, and that's an important distinction. Yes, M&A is a driver. They're integrating Florida Cancer Specialists and Prism Vision, which is their ophthalmology network.
Okay, some big acquisitions.
For sure. But, and this is crucial, even if you strip those out, the organic operating profit growth was still 15%.
15. So this isn't just financial engineering.
No, there is real organic demand for what they're building.
So walk me through that. When I hear oncology network, I just assume they're delivering chemo drugs. But you're saying it's deeper.
So much deeper. McKesson isn't just a vendor anymore. They are becoming the operating system for community oncology.
The operating system.
Yeah, the U.S. Oncology Network has nearly 3,400 providers now. McKesson gives them the tech for patient records. They handle inventory. They help with the insane billing and reimbursement for these therapies.
So for a doctor, McKesson is basically their entire back office.
Precisely. And think about the pressure on that doctor.
Yeah.
You have giant hospital systems trying to buy up every independent practice. McKesson comes in and says, we'll give you the infrastructure and the tech of a major hospital so you can stay independent.
Which explains that advancing community oncology report they kept talking about.
It's a strategic narrative. They're the defenders of the little guy. But, it's a symbiotic relationship. The doctor stays independent, so they stay in McKesson's network. McKesson gets the drug volume, the data, the service fees. It's a massive lock-in.
A huge moat. Okay, let's shift to the main business, though. The sheer volume of drugs. We hear about Ozempic and the GLP-1s everywhere, but the scale of what McKesson is moving is it's hard to wrap your head around.
It's the single biggest driver in their North American pharma segment. That whole segment was up 9% to $88 billion. But here's the stat that dropped jaws.
Go on.
$14 billion of that revenue was from GLP-1s.
Wait, $14 billion in 3 months?
Just in this quarter. That's a 26% year-over-year increase for that category alone.
Wow. So what about the bear case? The worry was that these are expensive drugs with lower percentage margins, that they'd be moving all this product and making no money.
Right, the empty calories argument.
Yeah.
But the segment operating profit still grew 6% to $872 million. So they are managing the mix incredibly well.
So how are they doing it?
This is where the logistics get fascinating. It's the cold chain. You can't just throw Ozempic in a regular truck. It has to be refrigerated.
They mentioned they're halfway through a 5-year plan to boost refrigerated capacity by 50%.
And that's not just buying a bigger fridge. These are pharma-grade, biosecure, temperature-monitored facilities. They are building another moat with infrastructure that someone like Amazon can't just replicate overnight.
That's the theme here, right? Building these deep, capital-intensive barriers. They also talked about using AI, which I found interesting.
The DSCSA tool, the Drug Supply Chain Security Act. It's a compliance nightmare for pharmacists.
Basically, you have to track every single pill electronically.
Millions of data points. And McKesson rolled out an AI chat tool to handle inquiries. They said it prevented 75% of issues from needing a human to step in.
That's a huge cost saving.
It's pure margin preservation. That's how you squeeze profit out of a volume business.
Which brings us to the segment where they sell pure solutions. Prescription technology solutions.
The margin story again. Revenue up 9%, but operating profit up 18%.
Profit growing twice as fast. What are they actually selling?
Access and speed. This segment is the middleman between the drug maker, the insurer, and the patient. Their job is to cut through all the red tape.
They said they cut down enrollment time for specialty drugs from days or weeks down to minutes.
That speed is everything. For a patient, it's life-changing. For the drug company, it means they book revenue weeks earlier. McKesson becomes indispensable.
And the efficiency stats are crazy. During that January insurance reset, they said each employee supported 120 more patients than last year.
That's the beauty of software. You add volume without adding proportional headcount.
Okay, so we've got the oncology rocket ship, the cold chain fortress, the tech efficiency. But we have to talk about the sick elephant in the room.
Ah, yes. The laggard. Medical surgical solutions.
Yeah, revenue was flat and profit was down 10%. They blamed a soft illness season.
Which is good for humanity, I guess. Bad for business.
Yeah.
This is the segment that sells masks, gloves, flu tests. When people aren't sick, volumes just drop.
But they have a plan. They're not just waiting for the next flu season.
This is the other big catalyst the market loved, the spin-off plan. It's moving ahead. They put the transition service agreements in place on January 1st.
What does that mean exactly, a TSA?
Think of it like a prenup for corporate divorce. It spells out how the two companies will share services like IT and HR while they separate. Getting it signed means the hard part is done.
And the timeline for the spinoff?
They're targeting an IPO in the second half of 2027.
So they're cutting loose the slower, more volatile part of the business.
Exactly. Addition by subtraction. The remaining McKesson becomes a pure play on complex, high-margin healthcare. No more, did enough people get the flu, questions on the earnings calls.
And speaking of cleaning house, they're finally officially done with Europe.
Yep, the sale of the Norwegian business closed January 30th. That was the final step.
Why does that matter so much?
It was a distraction. Different regulations, tighter margins, it split management's focus. Now they can pour all that capital and attention back into North America.
into more buybacks and oncology deals.
You got it.
Okay, that brings us to the part of the show where we get to have a little fun. We've done the deep dive. Now we get to look at the crazy.
Let's get speculative.
This is not financial advice segment, and we are serious. Please do not grade based on this. We're just brainstorming. But based on this call, what's a wild trade idea?
I keep coming back to that cold chain data point, that 50% capacity increase.
Okay, how do you play that?
I call this one the cold chain strangle.
The cold chain strangle. I like it. Break it down.
The thesis is simple. The future of medicine is biological. It's sensitive. If it gets warm, it's garbage. McKesson is cornering the infrastructure to handle it. So the long leg is easy. You're long McKesson.
You own the infrastructure of modern medicine. Okay, what's the short leg? Who loses?
You short the commercial real estate REITs that specialize in standard, non-climate controlled warehouses.
The concrete box providers.
Exactly. There's a glut of warehouse space, but it's the wrong kind of space.
Yeah.
It's dusty, dry, ambient storage that is becoming obsolete. The value gap between high-tech cold storage and dumb dry storage is going to blow out.
Long the fridge, short the shed. I love it. Do you have another one? A backup idea?
I do. This one I call the illness arbitrage.
Go on.
You wait for that MedSurg spinoff in late 2027, you buy the IPO.
Why? The numbers look bad right now.
Exactly. The valuation will probably be depressed because we just had a weak flu season. But biology is volatile. Eventually, we will have another bad flu season or another pandemic scare.
So you're buying the spinoff as a pure volatility hedge.
It's a perfect hedge. When the world gets sick, that stock will rip. Meanwhile, you keep the parent company, McKesson, as your steady compounder on aging and cancer care. You have a stock for when we live longer and a stock for when we get sick.
That is dark, but financially it makes a lot of sense.
That's the market for you.
All right, let's wrap this up. A textbook beat and raise from McKesson. But the real story here is the transformation.
It really is. They're embedding in oncology, building a tech moat with cold chain, and shedding dead weight. It's disciplined execution.
The GLP-1 wave didn't crush their margins. It just fueled their growth and their infrastructure build-out.
Exactly. The next big date is that spinoff in late 2027. But until then, the oncology and pharma trains are pulling all the load.
Thanks for listening to Talk Tickers. Do your own diligence, read the fine print, and we'll see you at the next print.
Stay curious.